September 1st, 2023. Today we got a measured move down of about the opening range. You can see to around the 28 and 29 low. That's pretty common on trading range days. When you have, when you have a reasonably sized opening range, that's maybe about half the size of what you would expect an average day to be. Just keep track of the sizes of the days. And when you have an opening range that's, maybe half the size of what it should be, just whenever you get a breakout, you got to understand the target that the market's probably looking for is the measured move. And you can see here we got basically a dump at the end, a vacuum test of the measured move. Bar one, bull bar, but not a very strong close. Probably buyers below, probably sellers above. And it's important that bar two was such a strong bear bar because now you have traders who bought below one who are trapped. So traders who buy below one should be able to make money. So we should get back up to the one low, but they're currently trapped. You can see we got a pause bar on bar three. So not many sellers below two because traders who were selling know that we're probably getting back to the one low. So when you don't get great follow through immediately on three, they start buying back shorts, causing the tail. Four, probably buyers below three. Again, you have to keep this magnet in mind. It's essentially two legs down at this point. Two and four are the two big legs, and three is the pullback. And then bar five is interesting because you get about 2 to 1 of your initial risk to get to the one low. And when you have 2 to 1, it's a reasonable swing trade. And so a lot of traders will buy above bar five. And I think there are two ways to manage buying above bar five. You can either buy above it and hope you get immediate follow through like you do on bar six, or you can buy above it. But if you don't get that immediate follow through, you need to get out within a minute or two of the bar opening. So it's a tough trade. Or you can buy above bar six or by bar five with kind of a wide stop. And when it trades below it, you can buy more lower. Thought process being if you get bad follow through on bar six, you can buy more lower and get out around break even. And if you get good follow through, you'll make money anyways. So you'll either probably break even or make money. But you know that this is an important magnet and that we might have to get here. You get follow through on six, and if you look at it as one push down on two, two pushes down on four, you know that even after five and six, you're probably still going to get a third push down for the bears to create a wedge because this is a pretty tight channel and you need that third push. You also know that bar five and bar six is strong enough for its own second leg. So when it trades down here, and it's going to be scary because at one point this was a big bear bar closing, this was a big bear bar down here at one point. It happened pretty quickly in the bar, but this was a big bear bar closing near its low at one point. And traders bought it because they know it's probably just a third push, and this is probably strong enough for a second leg. And since we're probably going to test somewhere back up here, it's reasonable to think that we're probably just going to get all the way back up to the one low. And so traders bought the third leg down, and we got a reversal up. And you can see even the true risk. So actual risk is a good concept to use when you're considering scalping out of a trade. If you had bought above five, no one really knows where you actually have to have your stop. There are traders that stops here, stops here, stops here, stops here. There are traders that stops all over the place, but no one knows where it's actually going to go until after you get, a good move. And so by the close of bar nine, it's pretty clear that, what you actually had to risk was about that much. That's how much you actually had to risk. And you can see we went basically one tick away from 2 times the actual risk. Since it's a swing trade, you want to get at least 2 times your risk. We went up to went 2 times away from your actual risk, and that's where we stopped. So I don't know if that made sense, but that's kind of the concept. Bar eight, bad follow through for the bulls. Not too surprising. If you're still long up here, you got to think about your risk reward. Where's your stop? It's probably somewhere down here, and your profit target's probably close to here. So if your stop's way down here and your profit target's there, you're basically risking, a lot to make a little. 10 follow through, we get to that one low. Sorry, 9 follow through, we get to that one low, and then 10. You could argue it's 2 legs up. You could argue, different computers would argue this is two legs down and then 3 pushes up. Regardless, that we're probably at the top of the trading range, and that's what's important. Bad follow through on 11, but buyers below. This is probably a tight channel. This is a tight channel, so it's probably strong enough for a second leg on a higher time frame. 13, big bear bar closing near its low. Yes, but potentially a second leg trap. I don't think it's a great sell below 13. And, the problem with selling 13 is when you get 14, what are you going to do? You can see the traders who sold below 13 were in somewhere around here. They're disappointed in 14. And so on bar 15, they're exiting around break even, causing the buy right here. So it's hard to sell below 13 and want to stay short after 14. So that's kind of the problem with that kind of trade. 15, doji. Like I said, bears buying back shorts, and then big follow through on bar 16. Probably trap traders below 15. You can see we never quite filled that gap, though I think that's one of the magnets we were trying to reach at the end of the day, but it was just a little too far. 16 and 17, good follow through for the Bears, but it could be a third leg down, and it's kind of hard to want to sell. And especially once you get 18, you have a big tail on the bottom. You know that bulls bought below bar 4 betting it's a trading range, and you can see if they bought more lower and scaled in, they made money on bar 19. So bulls bought, they bought more lower, and they made money on 19. So if limit order bulls are making money in your bear trend, it's not a very strong bear trend. Follow through for bears on 20, kind of just a second leg. From this, some would argue this resets the count because it's 4 strong bear bars. So 20, 21, probably buyers below the low one on 20. Not very good. You're selling probably what is the bottom of a developing trading range, and it's important that limit order bulls are making money. Second reversal up on 22. It's not the best buy, and it never ends up triggering. The reason I don't love it is because this is all pretty strong. So I'd rather go a little more sideways first, get a better trend line break, and then a reversal up. 24. So 23 doesn't trigger. Sellers above 23 on 24 outside down. Some traders will sell the breakout below, but with limit order bulls making money, it's hard to want to sell low because you think this is probably a forming trading range. And if this is a developing trading range, how much lower are we really going to go? You get bar, I think 25 and 26 and 27 are really important because once you have 4 straight bear bars, bears know that it's strong enough for a second leg. So once you get 4 bears, everyone's in agreement that it's strong enough for a second leg, and everyone's in agreement that this is the magnet, right? We're probably going to the measured move down. That's pretty common on trading range days. And so when you get 4 straight bear bars, a lot of bears will just sell the market. They'll just click sell the market because they know that either we're going to pull back and then get a second leg down, which they can scale in higher and make money on their second entry and break even on their first entry, or we're just going to vacuum down to the magnet and bulls are going to give up. And that's what happened. So bulls basically, they saw this and they just figured we were getting here and they just sold at the market as bears sold at the market, and that causes the dump on 28. 29, reversal up. We're probably going to get to the 27 low, I would assume. Why? Because, bulls, limited order bulls theoretically are buying below 27, betting against the breakout. And so when you get a breakout, the breakout gap should close on a trading range day. And you can see once we hit the measured move, there's no one left to sell, except for traders who think that this is going to collapse. But those are traders who are probably, losing money. Buyers. So buyers here, you get 29. Maybe some traders will buy above it, but it's kind of difficult to want to buy, this low. But you got to think of it as buying low in a trading range. Bad follow through 30 and 31. It's essentially a small second leg down from the bears from 28 because this was still strong enough for a second leg down. So 30 and 31 is the second leg. Bears disappointed in the second leg, start buying back shorts at the market. Basically, anyone who sold below 28, you can see on 31, those traders were let out to break even, and we got a big bounce 32. Follow through 33, 34, 35. Micro trend for the bulls, and we're breaking the trend line. So essentially, it could be setting up a major trend reversal. You need a trend line break and then a retest, which ended up coming later, and then a reversal. But yeah, 30, 35, 36, bulls taking profit at the first time at the moving average, which makes sense. You usually are going to take profits first time you touch the moving average in a little while. And you can see you got disappointment on 38 and 39 for the bulls, basically a 50% pullback of the whole rally. 40, bull bar closing near its high. Yes, probably an okay swing buy, betting that, you essentially get the trend line break and a lower high major trend reversal, or sorry, higher low major trend reversal. I think it's okay to buy looking to close the 15 gap. But you don't quite get the follow through you want on 41, and then tough call on 42. Probably just exit. It's 1 push, 2 pushes, 3 pushes up. So third leg up, get out below 42, I think. 43, 44. So a couple more bear bars, a little more follow through for the bears. So you can see anyone who bought the close of 41, disappointed 42, uses 43 to exit at break even. And then you get some follow through on 44, but it's just not that strong. We're probably going to pull back a little more. 45, 46, we do pull back, and then you get 47. It's a flat, the moving average is flat, so it's an okay swing short below 47, hoping we get back down to the 31 close and maybe a measured move down. But it's hard to take because a lot of times when you get follow through like 48, a lot of traders will just take the scalp. You can see there was 0 true risk on the trade. So we talked about true risk here. Where did your stop have to be? Well, here, your stop could have been pretty much right here. Literally could have been, you could have sold the 1 tick below and you never would have gotten stopped out. And so a lot of those traders see that and they just take the quick 2-point scalp on 48, knowing that it's a trading range day. And oftentimes traders will be disappointed. So when you get follow through like this, traders take it, betting that the next bar will be disappointment, which is what 49 was, and 50 was disappointment. I think 49 is, bears buying back shorts, and then any bears who are still holding, you get 50, and those bears are disappointed and they start buying back shorts. And that kind of goes leg one, pull back leg two. So it's two legs up, 49 and 50 essentially. And then, but do you want to buy up here? No, because you're buying in the top of a trading range. So we get another leg down, 51, probably going to get back to the 50 low, trapped limit order bulls. And 52 is a potential wedge, but doesn't close very strong. 53, bull bar, but yeah, not very strong. And then you get some follow through on 54, 55, but there's these tails, overlapping this high and this low, this high and this low are overlapping. So it's not that great, and it's not really breaking out of anything. You get 4 straight bull bars, sure, it's enough for a second leg, but it doesn't break out of anything. There's no rush up. You can see that the traders who bought it with 55, disappointed 56, exit around break even during 57. 58, you could sell 58. It's closing below the moving average. You're in the upper third of the trading range. You could sell, looking to get down here maybe, but you need good follow through, which you get on 59. And then you get 60. And 60 is important because it goes down and then up. So think of this as one leg, pull back, leg two on 61. So it's 2 legs down in the trading range, and you're at the bottom of a trading range, and you had a trend line break early in the day. So this is setting up for a major trend reversal, right? Trend line break, 20 plus bars sideways, and then 2 legs down to the bottom of the trading range. And bulls will buy here knowing that even if it isn't a major trend reversal, they still should get a bounce because it's the bottom of a trading range. So you get follow through on 63. Bit of disappointment on 64, but it never lets bulls, it never gives anyone a chance to get out with a loss. You can see bulls bought the close of 64, expecting that it was a bad reversal and it was going to fail. It didn't even let traders in below it. So they immediately bought the close of 64, and they got a micro gap up, follow through 65. Pair of bull bars for 66. You can see trap traders below 56 and 57. They're let out at break even during 67. And we essentially get 3 pushes up. And, you get a climactic finish on 71, 72, 73. But you have to keep in mind, with how strong this has been, it's a good micro channel, but this is the strongest piece of this. So you kind of want to be careful on these buying. For always in, was probably always in short on 2. Might have flipped to always in long somewhere in here. Maybe 6. I think it flipped back to short maybe on the close of 13, definitely by 16. And then it was always in short until probably 30, 32 or 33. There's not really a lot of reasons to be short down here. So that's why I think it flipped pretty easily with the 1 or 2 bars. Maybe back to always in short below 58, and then always in long, probably definitely clearly always in by like 65, but definitely okay to be buying above 62. I thought the best stop orders on the day were 62. Thought 47 was fine, though I might have to start weeding that one out. I did buy above 5, and I bought more lower. Yesterday, I tried to do a similar thing over here. I bought above 36, and I tried to scalp out really quickly, and I ended up losing some money. And it's just really hard to get out quick enough to avoid if you're going to buy these things that are potentially traps. That probably wasn't a great trade, though. But you can see if you bought above 36 and you bought more below 36, you're let out a break even on 38. And so I think it's a better way to manage that type of trade. Weekly chart, I think we're probably coming back to this week's high next week. I don't know if we touched this week's low. Did we? No, we didn't. So if we get up to this low, I think there'll be resistance. And if we get to this high, I think there'll be support. So expect a trading range. Daily outside down bar. Something else to note is outside down bars, 70% of them close within their lower third or within their lower third. So we get an outside down bar here. It's outside down days. And you can see we just barely missed it. So this is part of that 30% of days that does not close in the lower third. Yep. That was